Today, I want to answer another options question we're getting from subscribers, and this is a really good one. What's the difference between a cash secured put and a covered call? Now, on the surface, these look like two completely different strategies. One uses stock while the other uses cash. One sounds bullish, while the other sounds, well, also bullish. But here's the truth. They're actually very similar. In fact, in a lot of situations, they can produce almost identical outcomes. The big difference comes down to how you enter the trade and what kind of risk you're willing to take on. So let's break it down. Once you understand the mechanics, these are two of the easiest ways to generate options income. But this is where beginners get in trouble. You need to understand the risk, because these trades can feel easy and they can have high win rates. And you can stack up lots of little wins, but one bad trade can wipe out 5, 6, 10 winners. So let's get into it. At the end of the day, both of these are options income strategies. You're selling an option and you're collecting premium up front. And in exchange, you're taking on risk. I always tell people to think like an insurance company. Insurance companies collect lots of little premium payments, and every once in a while, a house burns down and they write a huge check. Options income works the same way. You collect lots of little premiums and occasionally you take a loss. So the question is never, how much premium can I collect? The real question is, am I being paid enough to take on this risk? That's how pros think. Beginners usually focus on the premium while pros focus on risk, and that's a big difference. Let's start with the covered call. And a covered call is simple. You already own 100 shares of stock, then you sell a call option against those shares, and you collect the premium immediately. Let me give you a real example using Uber. As I'm recording this, Uber is trading around $75.58 a share. Let's say you own 100 shares. You could sell the $80 call and collect about $7.20 per share. So $7.20 times 100 shares puts $720 cash right into your account. Not bad. Now, in exchange for collecting the $720, you're agreeing to sell your 100 shares for $80 if Uber goes above that strike price. So you're getting paid up front, but you're capping your upside. There are really three things that can happen. Number one, Uber stays below $80. Great. You keep the full $720 premium and you keep your 100 shares. This is the ideal outcome. Number two, Uber rallies to $85, $90, maybe higher, and your shares get called away at $80. Now, you still keep the $720 premium, and you make $4.42 per share in stock appreciation from $75.58 to $80. That's another $442. So total max profit here is $720 premium plus $442 stock gain. It equals $1,162. Sounds great, but if Uber runs to $95, you miss all of that upside above $80. That's the trade-off. And number three, Uber falls. Let's say it drops to $70. You keep the $720 premium, which helps, but your shares lost $5.58 per share, or $558. So your net result is roughly only a $162 gain. And if the stock falls harder, the chance you risk or suffer losses gets bigger. This is where beginners get it wrong. They see the $720 and they think, easy money. But the real risk is owning the stock. Your effective break even is $75.58 purchase price minus $7.20 premium equals $68.38. So if Uber drops below $68.38, you start losing money. If it crashes to $60, you're down about $8.38 per share, or roughly $838. That premium helps, but it doesn't eliminate risk. Now let's compare this to a cash secured put. This is another very popular income strategy. In this case, you don't own the stock yet, but you're willing to buy it and you have enough cash in your account to buy 100 shares. So let's say for this example that Uber is trading around $77.50. You might sell the $75 put. Looking at the chain, you can collect about $4.45 per share. So $4.45 times 100 equals $445 cash into your account immediately. And in exchange, you're agreeing to buy 100 shares of Uber at $75 if the stock drops below that level. So you're basically getting paid to wait. Again, here there are three possible outcomes. Number one, Uber stays above $75 and the put expires worthless. You keep the full $445. No shares purchased. This is a clean win. Number two, Uber falls below $75, you get assigned, and you buy 100 shares at $75. Now, because you collected $4.45, your effective cost basis is $75 minus $4.45 equals $70.55. So you're owning Uber at an effective discount. Number three, Uber rallies hard. Maybe it goes to $90. You keep the $445, but you miss the upside move. Once again, this is a trade-off we have to accept. The biggest risk is Uber crashes. Your break even is $70.55. So if Uber falls to $60, you're down $10.55 per share. That's about $1,055. So again, premium cushions the risk, but it by no means removes it. So what's the practical difference? A covered call is a stock-based income strategy. You already own the stock. A cash-secured put is a cash-based income strategy. You don't own the stock yet, but you're willing to. One starts with stock and the other with cash. That's really the biggest difference. And here's the funny part. These two trades can be very similar. With Uber at $77.50, owning shares and selling the $80 covered call for $7.20, or selling the $75 cash secured put for $4.45. Both are bullish to neutral. Both profit most if Uber stays flat or moves modestly. Both collect premium upfront with downside risk. And both limit some upside opportunity, so in these ways they're very similar. So when should you use one over the other? Use a covered call when you already own the stock and you'd be happy selling it at a target price. For example, if I owned Uber and I'd gladly sell at $80, I might write the covered call. Then I'd collect the premium and get paid while I wait. Use a cash secured put when you want to own the stock, but only at a lower price. For example, if I wanted Uber but only near an effective price of $70.55, I might sell the $75 put. Again, collecting premium and waiting. Here's an important mistake many beginners make. This is where they go wrong. They focus on premium. They think, oh, wow, I can make $445, or oh, wow, I can make $720. And they ignore the actual risk. Remember, these are not paychecks. They're risk trades. You're collecting cash in exchange for taking on risk. So always ask yourself, am I being paid enough for the risk I'm taking? If the answer is yes, only then you take the trade. If the answer is no, pass and move on. It sounds simple, but it's important to understand. If you want to learn more ways to generate income with options, I put together a free report covering some of my favorite options income strategies. Click the link below and download the free report, and I'll show you other ways to make money with options. See you in the next video. This content is for educational purposes only. It is not trading or investing advice. This is not a recommendation to buy or sell any security, nor is it a recommendation about any investment strategy. Options, futures, and options on futures all involve risk and are not suitable for all investors, and you may experience significant losses.